Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, October 31st. Happy Halloween to everybody. Can't wait for the grandkids to go trick-or-treating tonight. That should be fun. Welcome to today's Revere Daily Market Insight video. Let's get right into it. It is 4:19 p.m. Eastern Time. I threw myself off there, going off script with the standard entry. So state of the market, we're in a correction, but with a short-term uptrend within that correction. You can see over here on the trend gauge, we're showing bullish / uptrend for market leaders. Next thing we do is we take a look at where the indexes are, the 5 major indexes relative to their short-term 21-day exponential moving average, medium-term 50-day moving average, long-term 200-day moving average, and all 5 are above their short-term 21-day exponential moving average, and the slope is up for that. That's why we're showing bullish / uptrend for that. Medium-term 50-day moving average, I can slide this arrow a little bit over further. We need to see higher highs. We got subsequent closes above the 50, but we need higher highs to get off of bearish / downtrend. And we frankly also need some cooperation from the NASDAQ 100. Long term, our 200-day moving average, the Dow now with 2 closes above that, still showing red based on what's going on with the other 4 indexes, but the green arrow pointing towards neutral. So what happened today? If you look at the numbers here, it's all red, but I really don't consider it a negative day after the big up day on Friday. Today was really just a choppy inside day, and the US dollar and rising rates provided a bit of a headwind today. You could see the intraday wiggles when the indices came lower. You can either see the dollar or the rates going higher and vice versa. Bottom line though, not too bad. G6 down 0.21%, S&P 500 down 0.75%. Just a reminder, on Friday, the S&P was up 2.46%, the NASDAQ was up 3.1%, the Dow and small caps were up 2.3 and 2.6%. So these not even giving back half of it, and that's why I colored the comment in yellow and not in red, despite the red numbers. So NASDAQ 100 down 1.16. Dow continues to lead, only down 0.4%. Mid caps down a tenth. Russell 2000 barely negative. Global diversified 60/40 stock bond down 0.5%. In-house, our flagship GROTECTION down 0.6%. We'll get to the tail of the tape and charts of interest today. We're going to focus on some Dow stocks. If you're wondering why the Dow is leading, it's because the higher weighted components in there have some pretty nice looking charts, and that's what we're going to take a look at. But let's get right into it. Let me first describe why we do what we do here at Revere using a chart of the S&P 500. We are trend followers, taking a look at what the major indexes are doing versus their short-term 21-day, that's the green line, medium-term 50-day, that's the red line, and long-term 200-day, that's the black line. What are they doing relative to that? And then also what leading stocks are doing. So perfect scenario, last October, November, the market, in this case the S&P 500, trending above all 3 moving averages, and they're stacked the way you want them to be. At this point in the market, we would have as much money in the market in leading stocks and the indices as we would feel comfortable doing. If it starts to roll over, our stops will take us out of the market. We'll pull back a little bit. If we really start to roll over, the slopes of the lines will roll over. This is really the first sign that, hey, the price action has been negative enough to catch up to the moving averages, and now that they're rolling over, those went from being a tailwind to being a headwind, and you can see this really started happening in early January. And then if we break the black line, that's the 200-day long-term moving average, we are particularly increasing our defensiveness there up to the maximum. And the reason for that is this chart here. The last 13 bear markets, all bear markets occur beneath the 200-day moving average. There are various duration, there are various severity, but on average, you're down 10 to 13%. The average is about 12 by the time you break the 200-day moving average. That's easy to come back to. Very often, the indices just pull back to there and bounce. But if they pull back to there and don't bounce and they break, then you're under the scenario where you could get a bear market and possibly a severe bear market. Risk management is our number one job here at Revere. We do this to prevent anybody that has saved their nest egg from watching it disappear because of a negative sequence of returns. Sequence of returns is what the indices return each year. Long term, the average is about 8 to 9% on the S&P 500, but there are very severe short and intermediate terms in there. And if you're headed into retirement, your portfolio can get devastated if you don't protect it. That's why we take it extremely seriously, and we protect capital. We've got rules for getting out, rules for getting back in. Speaking of getting back in, we have done 13 various times that we've stuck a toe into the water. In fact, at a couple of times getting all the way up to our waist or mid-chest, you could say, but never fully in because we never got back above the 200-day moving average and never got the indices configured the way we wanted them to as far as the slope of the line goes. Right now, we started putting some capital back in because of this undercut and reclaim. This is called a washout bar. Everybody that needed to sell did sell. It came after 6 straight down days, piled bad CPI news on top of it. That was the final selling, getting out, and then a sharp slingshot. You can only stretch a rubber band so far before it snaps back. And that's purely what that was. And it's still snapping back. It snapped back above the green line, the 21-day, and now above the red line, the 50-day. And we just keep putting capital to work because we're getting a positive return, and the indices are showing the willingness to participate in this. Along with that, we've been seeing quite a bit of rumors of increased dovishness by the Fed, meaning they may measure their pace of additional rate hikes. We're fully expecting a rate increase of 75 basis points, although the odds for a 50 basis point hike have been increasing over the last week. But what happens after that is what the market is going to be focused on, and several central banks across the world have already softened their stance a little bit. We're expected to raise rates more than they did. So the market betting that the Fed is going to follow through on that. So basically, we follow the trend, we follow macro headwinds, tailwinds, we follow what the charts are telling us to do. And if you're interested in this approach, we'd love to discuss your current situation with you and compare it to ours. You can email me, don@revereasset.com. You can also email dan@revereasset.com. He's the CFA and president of Revere. Mr. A to Z, all things financial, I call him, and he'd be glad to talk to you about how we do things here at Revere, and I'd be glad to explain how we do things in the portfolios, which pretty much I just gave a high-level view over the last couple of minutes. But feel free to reach out, Don or Dan at RevereAsset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. So what happened today? You can see the big up day on Friday and the very tight range inside day today. Perfectly normal behavior. Let's go to a 60-minute chart. You can see the move up here. First of all, the big washout here on 10/13 that started with the move below the lows, gap down on bad CPI, but that's it. We had a slingshot higher, a sell-off the next day just to test. You always get a retest after you get a move up above a formerly broken resistance. I'm not going to say always, there are no absolutes in the market, but it's frequent. In this case, it held. Then we had 2 following gap up days the next 2 days, 3 days of consolidation, 3 days of a move higher, 2 days of a pullback, 1 day up, and now this very tight move inside of Friday's range, 3,900, very clearly resistance here. That's the next level that we need to get above on the S&P 500. Let's take a look at the laggard index, the tech-heavy NASDAQ 100. You can see it's holding on, second close above the 21, but not a higher close above the 21. Still below the declining 50-day and the furthest away from the 200-day at 11.5% below. of all the 5 major indexes. Let's go to the leader, old reliable Dow Jones Industrial Average, second close above the 21, not a higher close, however. But when it pulled back right to the 200-day and it held, that's exactly what the type of action that you want to see. We are weary that are aware that we are in overbought territory, and the stochastic did hook lower today, but that's because of the pace of the move up was so much higher. As soon as you get a slowing down, you're going to have the stochastic start to roll over. But you can see you can spend weeks above overbought here, as we did in this last wave up here. 4 weeks in overbought territory during this move up. This move up actually has been even stronger on the Dow versus this one as far as pace and how quick we went higher. So there's your Dow. On the pullback today to the 200, we added UDOW. I'll talk about that when we get to portfolio changes. Let's move on to mid caps right now. Mid caps made a higher high intraday, so not an inside day there. Mid caps and small caps led most of the day, gave up some of it by the end of the day, but you can see here now 4 closes above the 50-day moving average. We really need to see the slope of the line flatten out and turn up, and we're going to get the 200-day crossing up unless we fall apart big time on Wednesday when the FOMC announces their rate hike decision. Here's small caps. You can see 1, 2, 3, 4, 5, 6, 7 straight positive days on small caps, a higher high, 4 closes above the 50-day, coming into the 200-day moving average. Yes, we know we're in overbought territory here now, but still headed higher. And go back to what I said before. Here's 3-4 weeks above overbought. Last time we were rallying. So what's very critical where the rubber's going to meet the road is what happens when the rest of these indices come into the 200-day moving average, and that will probably be strongly impacted by what we see on Wednesday with the FOMC decision, and not only that, their indication of what they're going to do going forward. US dollar had been and I'm using ticker UUP for the ETF here, had been providing a tailwind over the past 2 weeks to stocks. 3 up days now on the dollar, and you can see the stochastic hooked up. That's a negative. Also closed above the 21. That's also a negative. So this is something we really need to keep a close eye on. As you know, there's been a big contrary move in the dollar versus what's going on with the indexes. Dollar up, stocks lower, dollar down, stocks higher. So very clearly something that we're paying attention to. Let's look at TLT, which is the 30-year bond price. It was down. That means interest rates are up. Let's look at the TYX. This is the 30-year bond. We held the 200-day moving average after a 3-day pullback, now bouncing higher. Let's look at the 10-year 0TNX. Same thing, bounced at the 21-day moving average and going higher. This is not good for stocks. We want to see this to continue to fall. We want to see rates continue to fall to make stocks more attractive. Let's take a look at the VIX. We've had another close below. The VIX up less than 1% today, despite the indexes being down. This is another reason why we consider today to be a yellow day and not a red day. 2 closes below the 200, multiple 4 closes below the 50 now, and the slope of the 21 is rolled over. This looks directly opposite to what we're looking at on the Dow Jones Industrial Average and the S&P, with the exception that the S&P hasn't gotten above the 200-day moving average yet. Yes, we're oversold on this. We're aware of that. Would expect some moderation normally, but some reversion of the mean. But in this case, the FOMC is really going to be the tail that wags the dog come Wednesday's decision. Bitcoin BITO, this is the ETF representing the futures, down today. Let's take a look at the 60-minute chart on this. Coming down to where we had this breakout at 1250. This is a really nice flag. Normally, consolidations after a move up resolve in the direction of the initial move. We'll see. You can see we've got alert set at 13 and 12.5 to let us know which way this breaks. We'll also take a look at the barbaric yellow metal GLD down day today, really oversold on the stochastic. You can stay oversold for weeks, as you can see going back historically, but really, let's look at the daily chart. No reason to be in this. Just for the sake of diversification. As I always say, that's the equivalent of buying rotten vegetables to have a balanced diet. So those are the major charts that we like to take a look at. Let's take a look at the tail of the tape now to see what changes we have. Correction with the short-term uptrend, no changes on the headwinds. A couple changes on technical. We're still positive on the indexes in the G6 from a stochastic standpoint, and the NASI and its RSI are positive, but on the negative, you've got the dollar above the 21 coming. The stochastic is now negative also, and you've got the 10-year and the 30-year back above their 21. Put calls at 0.9, VIX is at 25.94, which is still below all these moving averages, which is a positive. Fear and greed ticked down 2 to a 59. We're operating under the bull case with the follow-through day, a plethora of leading stocks, and the continued move higher in the indexes. The bear case would take precedence back if we broke the 21 on the indexes and the rally failed. Some news this morning. The largest utility in the Northeast warned of winter nat gas shortages and asked the White House to try to do something about it, but that resulted in a spike up of natural gas of 9%. Our day count, we went from up 1 to up 1 with an inside day, so that's considered what I call up 1 C1 or a consolidation day inside of an uptrend. Wednesday, here's the big thing that we're looking for, the rate hike decision. Expectation coming today was positive based on the recent follow-through day. Today, kind of a neutral inside day, despite the fact that we finished in the red, as I've already talked about. Key levels between support resistance level, this 38.50 to 63 area, and the breakout or resistance area, 38.87 to 39.07. This is where we closed on Friday. And moved actually within this range is where we closed on Friday, and spent the day between those two levels. NASDAQ 100 support held today, this 275 to 277. It will be a big positive for the NASDAQ 100 if you can get above this 286.82 fib, today's high. We're still 2.5–3% below at today's high, just shy of 280. Bottom line, inside choppy day. With trend driven by the U.S. dollar and bonds. What sectors worked today with the dollar up and that news on nat gas? Nat gas was up. Commodities were up, including agriculturals, oils, coal. Solars were higher, and banks were higher. On the downside, we had bonds, semiconductors, tech stocks, two of the big tech sectors, biotechs were down, and gold, silver, and gold and silver stocks. What were we focusing on today? I'll take a look at these charts momentarily and tell you why I was looking at them, but we're also focused on what the Dow is doing versus the 200-day moving average. When it pulled back and held, we added 5% UDOW, which is a leveraged Dow ETF, which brings our portfolio exposure to 1.13. We don't really expect to go much higher than this, for several reasons. One, where we are relative to still being beneath the 200-day moving average, and then also the big FOMC decision today. If we do add something, it may be something like TBT, which would be lately, if the TBT is up, the markets are down, so it would be a diversifier. If we pick that, and TBT chart is looking nice on the rebound today on rates. Bottom line, as I said, choppy inside day, trend driven by the dollar and bonds. This is the key level that we're wanting to get through. It's 38.87 to 39.07. Closed inside that on Friday, gave back some today at 38.72. So let's take a look at those charts that I was focused on coming into today. And let's start with ON. This was because they announced, this is one of the silicon carbide stocks, and the other one, Wolf, had a very negative reaction to its earnings report last week. On also a negative reaction to its earnings report, down 9% on heavy volume, despite nice growth numbers, but it was their numbers for Q4 going forward that disappointed, and you can see here 2023 they actually are showing a negative EPS growth. Their PE is very reasonable at 13, but the reaction is what we go by. Next thing to look for this is, will the 200-day moving average provide support for this? And we'll set an alert near there to let us know that it doesn't. Let's go to Wolf, which was the other one that had the negative earnings reaction last week on the big gap down. This is approaching the lower low of its gap down day. Definitely not a positive. And I'm going to alert myself there if that breaks. So what does that mean for AEHR, which is something that we own? Held up and actually made a higher high early in the day. They make the test systems that both of these clients use. Made a higher high intraday relative to Friday, but then had a reversal. Volume just average. In fact, the volume pattern slightly below average, or sorry, just 6% above average and lower than the accumulation volume that we've seen recently. But we don't ignore price action as long as the breakout holds, we're okay. We added to it here on 1027. We're watching that cost basis. Don't want to go too far below that, but really the line in the sand for this is the low of 1027 for this position that we're holding. So ON was one that we were looking at. The other ones that we were looking at coming into today that I was focused on was, how would some of the gaps that reported good numbers act relative to their gap last week and where they are in their base. So you can see this nice breakout by wing, good a higher close on day 2 and day 3, but still within the wick being the difference between the close on the gap up day and the high of the gap up day. We poked our head above that. This is consolidating very nicely, and it's near the top of our buy list if we get a positive reaction to FOMC. Really like the look of this. First Solar was the other one we wanted to keep an eye on because of the good reaction to end phase, the choppy reaction to First Solar on its earnings on Friday, as both of them were trying to regain leadership. This had relative strength out of the gate today, ended up having a very good day, up 9.7%. We didn't add to it, again, because of where we stand going into FOMC day on Wednesday. The third stock we're looking at is MEDP. Also very high on the buy list as it continues to consolidate very nicely near the top of this cup base, putting in a handle near the top of this cup base after its nice move up on big volume on its earnings, 703%. When you see volume that high, you get and a move up 38%, you got to pay attention. It means Wall Street was off sides. The only question is, how is the market going to continue at that point? And how is the stock going to react when it's lower, when it's short-term moving averages catch up to it, particularly the 8 EMA. Caterpillar, from an industrial standpoint, was the other one I wanted to look at. Really like this move up on its earnings gap. Note it's still inside the base and made a higher high on day 2 and an inside day today. This is acting very well also. And then TBT I mentioned as a way to diversify. TBT, this pretty much looks like the chart of the 10-year and 3 days of a pullback, held the 21 back above the 21, although it did close at the low of the day today. So stochastic has rolled over. Does this have more consolidating to do, or is it going to take off again after holding the 21? That's the decision that needs to be made there. So those are the charts that we were focused on today. Some of our holdings that had good days today, STNG, we'll be watching their earnings tomorrow. We've got a small profit on this one. Very nice consolidation on lower volume after this 5-day move higher off of this consolidation near the 50-day moving average. So we'll see how that reacts to tomorrow's earnings. Also a good day for LNG. As it tried to break out, finished in the lower part of the range, but you can see the cup and handle showing up on pattern recognition there. They've got earnings later this week, and PI made a higher high on day 3, but reversed, closed inside. 3 nice tight closes there for this, and again, Massive volume on this one, 620%, up 30%, gapped to new all-time highs. So this is a blue sky breakout. Out of the base, very nice. The volume's there. We own it, and looking to increase our position if we get the behavior that we want. So that's going to wrap it. As always, love to hear from you. I'm on Twitter. Oh, no. We're going to look at the Dow 30. We're not finished yet. Almost forgot about that. So let's go to the Dow 30, and we're going to look at some of the top stocks in there. Remember, this is a price-weighted index. So I've got this sorted by the current price and how are those stocks acting relative to what the Dow is doing. So here you have UNH, blue ball here on the chart, which means relative strength at a new high. Had a shakeout here, positive reaction earnings coming out of this cup and handle. Goldman Sachs, high priced. Look at all the straight days up on Goldman Sachs since its earnings report and the little shakeout. Home Depot, decent move, high price stock, still below the 200-day moving average, but you can see how it's trending higher. McDonald's, increased their dividend, good reaction, gap up to their earnings right at the top of this base. Amgen, moving up very nicely. They've got earnings later this week. Microsoft, one fly in the ointment here from a high price stock. Caterpillar, on the other hand, nice gap up on its earnings report and consolidating. Visa gapped up on its earnings report and now has gotten back above the 200-day moving average. This tells me that the consumer is holding up okay based on the numbers that Visa and MasterCard have reported. And that's a good sign for the economy, not necessarily a good sign for the Fed, as they need to see some slack in demand to bring inflation down. And let's do one more Honeywell, because I know that it gapped on earnings also. Not as strongly as the other one, but relative strength at a new high. Note these are all very high priced. When you get down to the bottom here, these stocks barely record relative to their impact on the overall index. And some of these don't have very good relative strength at all. Intel, only a $28 stock into its 200-day moving average. Compare that to these $500, $300, $200 stocks. So this is really, it's a lot easier to manipulate this index by flooding money into these high-priced Dow stocks, these top 10 in particular. And there is a theory by an economist that I trust very much, Martin Armstrong, who says that when big money flows into the Dow, that's international money. When the NASDAQ leads, that's more domestic driven. But the fact of the matter is, you just look at the chart and what it's doing. It's rare that the Dow leads on a relative strength basis when the price is going higher, but that's absolutely what's happening over the last couple of weeks. So that's it. Email don@revereasset.com, phone 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make, it's how much you keep in the markets. And if you're interested in our approach, please reach out to us and tell your friends and family if you think they'll benefit from our content. So wrapping up the last day of October, this is Don Vandenbord with Just the Facts, telling it like it is here at Revere. Thanks for listening and have a great day.